Hi, everyone. This is Kevin Melchior from Tenet Wealth Partners, and I hope you're all having a great fall season thus far. Well, it was an eventful third quarter with both ups and downs, especially in the month of September. And now, as the fourth quarter is well underway, there's a lot to keep an eye on as we get closer to year end, both in terms of risks and opportunities. But let's start off with just a recap of how the third quarter ended. So, after a strong start in July, equity markets experienced a lot of downward volatility into August and September. Commodities were the only positive performer in Q3, followed by emerging markets, U.S. growth stocks, and U.S. Treasuries, which generated the least downside of global market indices. Real estate equity continues to struggle, dropping over 8.5% last quarter. U.S. small cap, Russell 2000, also fell sharply in third quarter, dropping over 5%. We also saw a slide in fixed income markets as interest rates climbed higher. Aggregate bonds and muni bonds specifically both ended the quarter down over 3%. So we've continued to see rates rise through October thus far as well, with the 10-year Treasury yield climbing above 5%, which is the highest level since 2007. On the bright side, all major equity indices have remained positive year to date through the end of third quarter. Small cap, mid cap, and emerging market stocks have retreated and are now negative for the year after a rough start to October as well. But the S&P, NASDAQ, and Dow are all still back in the black for the year. Now let's move on to the three key risks that we're watching for the remainder of 23 and into early 2024. There's certainly been several things that have happened this year to cause market volatility, but these have been the main drivers thus far. And of course, this year's volatility would not have been the same without the continued focus on inflation and subsequent actions by the Federal Reserve. Inflation's come down dramatically since last year's high of 9%, but we recently saw an uptick as sticky parts of inflation, such as shelter, have kept inflation above the Fed's 2% target. The Fed has also indicated that they will remain resolute in its commitment to bringing inflation down to their target after already hiking the Fed funds rate significantly since last year. And as seen on this chart, many expect the Fed to hike maybe one more time this year at a 0.25% clip and then pause, followed by a potential rate cut sometime in 2024. However, relating to that key risk, number two, continued hikes by the Fed to fight inflation may lead to a mild recession or some form of economic slowdown. And we've actually seen the leading economic index fall yet again last month, indicating a slower period of growth and potential recession on the horizon. Also on the consumer side, data has appeared strong on one hand with retail sales, as you can see, and spending and income all up over the last 12 months. On the other hand, other data such as a falling savings rate and increased household debt indicate that inflation and high rates is starting to take its toll on Americans, which could lead to less consumer activity in the near future. But there is still some hope that we could stave off a recession or, worst case, have a mild one or even just a brief slowdown before turning the corner back to growth mode. We have seen several economic surprises, as shown on this chart, so far in 2023, including better than expected earnings and jobs data, which does indicate that a soft landing is still possible. Now let's move on to opportunities we're seeing. Even with this year's jump in major equity markets overall, there are still attractive options for investors to consider. And let's start off with bonds, and more specifically, investment-grade bonds of longer duration. While price returns of bonds have taken a hit this year, many of you have probably seen on statements, with rates continuing to go up, we are seeing opportunities to secure and essentially lock in attractive rates for a longer time period. Across the spectrum of investment-grade bonds, we're actually seeing yields in the 5 to 6% range, as you can see on this chart here. And looking now at Treasury yields and the yield curve, we previously saw the sharpest increase in short-term rates recently, but we've also seen longer-term rates go up as well. So long-term Treasuries are now well above 4%. And as an investor seeking more stability in an income, longer-term investment-grade bonds may be an option. Plus, if rates eventually come down in the future, which many predict, investors would see the reverse happen, which is an increase in market value of their bonds, since bond prices and rates have an inverse relationship. On the equity side, small and mid-cap stocks are still trading at attractive valuations. Mid cap is trading at a 7 to 10% discount, while small cap is even more attractive at a 7 to 16% discount to 20-year averages. And speaking of small cap, profitable companies in the Russell 2000 index are trading at a 33% discount, compared to the S&P 500. And with improving sentiment as well as historically low valuations of these profitable companies, an increase in the long-term attractiveness of small cap is being seen here compared to large cap. And finally, let's talk about private credit. And next to bonds, this asset class continues to gain a lot of attention amongst investors. Even in the Wall Street Journal, they did a recent article on private credit, dubbing them the new kings of Wall Street. And for those unfamiliar with private credit, think of it as a private, non-bank firm lending to businesses who need financing as opposed to going to a bank for traditional loans. These private credit firms can be more flexible and creative on terms. They don't have the same underwriting constraints as banks. And so combine that with the regional banking crisis we saw earlier this year, and the attractiveness and growth of this space has been exponential. And that's, in fact, put some numbers behind it. Private debt has climbed nearly 300% since 2010, and private credit assets under management have jumped to nearly $1.5 trillion. Speaking of banks, $40 to $80 billion in traditional bank loans are expected to come due in the next 2 to 3 years, and a significant number of bank loans have already been converted to private debt, both last year and thus far in 2023, which just adds to the potential growth in this space in the coming years. And for investors looking for yield, the yield on private credit investments, specifically direct lending, can be very attractive compared to traditional bonds and even leverage loans and high yield bonds that generally have higher rates as it is. So with yields of over 11%, these direct lending private credit investments can provide both an attractive source of income while also adding an additional layer of diversification. So as we head into the end of 2023, we're going to continue to watch and monitor risks and opportunities in global markets closely. And we are hopeful that markets close the year out on a strong note. Of course, if you have any questions, please don't hesitate to reach out to us. Until next time, I'm Kevan Melchior with Tenet Wealth Partners. Thank you for watching, and we'll see you again soon.